Evolving economic, technological, consumer, and regulatory forces have the Asia-Pacific insurance market in a continued state of flux. And here to discuss these markets is Myles Gould. Myles is Director of Analytics in AM Best Singapore office. Christie Lee, Senior Director in AM Best Hong Kong office. And Greg Carter, Managing Director of Analytics based in Singapore. And Greg, let's kick things off with you. What are the top issues on the minds of insurers in the Asia-Pacific region?
Well, John, you have to realize the Asia-Pacific region is a very big area, very broad market in differing degrees of development. So when we talk about Asia-Pacific, it's very difficult to generalize across the whole markets. You've got some large, well-developed, mature markets down to some relatively small, underdeveloped or in the early stages of development in terms of the insurance markets. And I think since the global economic crisis of 2008, Asia-Pacific has been seen as a big opportunity for growth, an expectation of big growth opportunities. And with that has come a lot of inward investment, a lot of capital has been attracted to those markets in order to try to take advantage of those growth opportunities. So that has led to the markets remaining quite competitive, and they are growing quickly. We're seeing different rates of growth across different markets.
Are we seeing any regulatory developments or trends in the region?
Well, similarly, again, we have markets in different stages of regulatory development. Some markets are very mature. They have well-established and robust regulatory regimes that have been in place and have been developed over many, many years. Other markets, we're still seeing those early stages of development. We're seeing markets where there's still a degree of protectionism, there's tariffs in some of the markets, but slowly we're seeing a trend of that breaking down. As regulatory standards rise, then those protectionist activities tend to fall away as regulators look to encourage growth, encourage competition. Because when you have those barriers to entry, capital tends not to be attracted in the same ways. So in many markets we're seeing that ongoing development. Markets such as Singapore, which is taking its risk-based capital regime onto the next level. We're seeing a similar imposition of risk-based capital in Hong Kong over the next few years. And we're seeing developments, again, at the next stages of risk-based capital in markets such as Thailand. And what we generally see with those increased regulation, often it makes it a bit tougher for the companies operating in those markets. And from a credit perspective, you could regard that as a negative. But generally, once you raise the standards and you raise the capital requirements, then you get an improvement in credit quality over the longer term. And that's sort of the broader trend that we're seeing across those markets.
Christie, what are some of the trends that we're seeing in the Chinese insurance market?
China insurance market is still leading the global growth. And in 2018, China continued to record a double-digit growth on non-life insurance market. However, the underwriting quality continues to deteriorate since the implementation of the motor de-tariffication in 2016. In 2018, because of the macroeconomic environment uncertainties, the market has recorded negative motor new car sales drop in the first times in the last decade. That add top-line pressures to insurance companies because motor is the largest line of business in non-life insurance market. In addition, because of strong competitions that leading to high acquisition costs, many non-life insurance companies are facing very thin or even negative underwriting margin on the motor line of business. As a result, we observe that many insurance companies are changing the business strategies to diversify the book of business to other lines of business, such as health insurance, also credit and surety, and liabilities business. In longer term, we think that it will be more healthy for the insurance market, as well as continue to drive growth for the overall insurance market. On the investment side, because of the trade war between China and the US, that adds additional uncertainties to the economic outlook. As a result, that add volatilities in investment return, and overall both underwriting pressures and investment pressures do have we observe that have some major impact to the 2018 overall profit.
Can you talk to us about what the impact of some of the 2018 cat events had on Japan's insurance market?
Sure. 2018 was a very eventful year for Japan non-life insurance market. So there were earthquakes, heavy rain, and two major typhoons, Typhoon Jebi and Typhoon Trami. The typhoon events and as well as the heavy rains have exhausted some of the lower layers of the wind excess of loss reinsurance treaties, as well as heating the aggregate cover of some of the non-life insurance companies. All these add up, meaning increased insurance costs, and we observed that in the past 4/1 renewal, there were major reinsurance rate hike, especially on the loss impacted property layers.
Thanks, Christie. Let's move over to Southeast Asia now. Myles, can you talk to us about some of the trends that we're seeing there?
Yeah, sure. I'd like to pick up on the growth angle. I think Southeast Asia includes a number of the emerging markets, which certainly over the last decade have been touted for quite significant growth. And I think what I would observe is that with the ongoing US and China trade wars, we're seeing a slowdown in those growth prospects for some of those markets at the moment, and that's creating a different level of pressure and observation for some of those companies. Where previously they did have the top line to support growing economies of scale, that has increased some of the scrutiny on the expense line.
Is that having an impact on competition in the market?
Yeah, sure. So I think competition is certainly an important factor for a lot of insurance CEOs in Southeast Asia at this point in time. It is definitely different market to market, line of business to line of business. But I think what we observe with the majority of insurers that operate in this space is that the retained lines of business are really motor and medical. And they are also two of the lines of business that we see certainly a heightened level of competition coupled with that growth aspect that we mentioned a moment ago. So I think that's certainly putting some pressure on profitability, and really some of the profits that we are seeing come through on the technical side are being borne from some of those property and engineering risks, which are in fact being ceded to reinsurers and receiving inwards reinsurance commissions as a result.
Can you talk to us about the balance sheet performance fundamentals that we're seeing from insurers in Southeast Asia?
Yeah, sure. So I think the balance sheets of these insurance companies typically remain robust. We see capital adequacy from a regulatory perspective, but also AM Best's view of capital adequacy, typically at adequate or strong levels. And we haven't seen material reductions in that across the whole industry. I think where the pressure does lie, and that really comes back to what we were just talking about in terms of competition, is on the profitability side, on the operating performance, if you will. And that really does stem that if you're not growing at the expected rate, you've got to manage your costs better. And obviously with the competition from a premium rate perspective, the loss ratios have seen increases in some cases.
Greg, how important is innovation to the Asia-Pacific market?
Innovation is a subject that seems to be sweeping the insurance market currently, and we've certainly done a lot of work on developing our methodology for assessing companies' innovation. It's certainly a big issue across Asia-Pacific. Not surprisingly, innovation does require investment typically, so it's probably in the more mature markets where we'd expect to see the impacts of that innovation have greatest effect. But that's not to say that innovation isn't taking place in some of the smaller markets as well. So I think you need to drill a little bit deeper and go from market to market to see what that impact is.
In the more mature market like China and Japan, because they have the economy of scale, so insurers are investing into innovation and technology to serve the purpose and resolve some of the problems. Let's use Japan as an example. Because of the aging populations, so the technology to help them to automate the process, the operational process, and it would help them to eventually drive down their expense ratios. And in China, because of the high usage of mobile phone and and also internet. So technology is being widely used as a distribution channel. And in recent years, we also see that technology firms are getting into insurance field by acquiring or establishing their own insurance companies. Some innovative, very innovative insurance products launch in order to complete the overall ecosystem of those technology firms.
Yeah, and I think it's important to note that innovation comes in many different shapes and sizes. And whilst you see the more mature markets often having a strategy around developing their innovative nature of doing business, we're seeing it with emerging market companies as well. And it can be an avenue to manage costs in a better way, big data to better select the risks that you're underwriting. But we're also seeing companies develop it to really grow the customer experience in terms of policy documentation issuance, claims management, and really getting themselves closer to the customer and developing a more favourable experience.
Thanks, Myles. Thank you as well, Christie and Greg. For AM Best TV, I'm John Weber.